Insurance companies make millions per year by taking risks from others in exchange for a premium. For example, if you own a car, you probably have car insurance that protects your asset against an accident or theft. The insurance company collects a premium each year to protect you against the big loss. For an insurance company to make a profit, it must know what risks it's willing to insure and how much premium it needs to charge to be able to back the risks. Here you can see a simplified example of how car insurance companies make a profit. Now, let's say that this insurance company insures 10,000 cars at an average of $1,000 premium per vehicle. That gives us a total income or premium received as $10 million. Now, let's say of those 10,000 cars, there is a 10% claim rate. So 1,000 claims, an average of $4,500 per claim. Therefore, that leaves us a cost of goods or cost of doing business of $4.5 million. Therefore, that leaves a profit of $5.5 million. Again, as a gross profit, there will be other expenses such as salaries and admin, marketing costs, etc. But from a gross profit perspective, you can see how this insurance company is profitable based on the number of claims it actually has taken versus the cost of each claim. Now, you must be thinking, what does this have to do with selling options? Well, when you sell a put option, you accept the risk from the option buyer of owning the underlying asset in exchange for a premium. Now, here is a side by side comparison of a car insurance company versus selling an option. The first line item is about the insured asset. So, in the example of a car insurance company, the insured asset is a car. For selling a put option, it's all about the underlying asset. And in this example, we're going to use ABC Limited and we're going to assume that it's trading for $100. The second element is the time period. So for car insurance, the insuring period is generally for a year. When you sell a put option, there are a number of expiration dates ranging from a week all the way over a year. However, the most common date to expiration is 30 days. The third part is all about the cost of the buyer. So in car insurance, it would be valuing or insuring the value of the car, in this example, $20,000. From a put option perspective, it is the strike price, which in this case is going to be $90 times by the number of contracts. In this example, will be one contract. So one contract equals 100 shares. So therefore, the underlying risk or the insurance risk is $9,000 for selling a put option. The next 1.4 is all about the deductible. And for car insurance perspective, what this is sometimes for people that are taking out car insurance and want lower premiums, they are willing to pay a deductible or an excess when they make a claim. So in this example, it's going to be a deductible of $2,000 or 10% of the insured value. When you sell a put option, you as the seller select the strike price. So this would be the percentage out of the money we are from the current price. So ABC Limited is currently trading at $100, and then we are going to write or sell a put option at $90, which is 10% out the money. The fifth part is all about the premiums collected by the buyer. So from a car insurance perspective, the insurance premium to value or insure this asset for $20,000 is $1,000. From an options premium perspective, it is $4 per share in premium. Now, that is because we're doing 100 shares or one contract, so that'd be 4 times 100, where the total premium received would be $400. The next part is all about the profitability or loss ratio. So for car insurance companies, they've estimated that the percentage of a claim to be made is around 10% or 90% chance that no claim would be made. And again, very similar from selling a put option perspective, due to the implied volatility of the stock, and through the option Greeks, there's a probability of profit of 90%, i.e., there is a 90% chance that this option will expire worthless or out of the money by date of expiration. The seventh part is all about the closing of the period and what happens. So for car insurance, after the year or during the year, is were there any claims? If there was a claim, then they would have to pay out whatever that payout ratio needs to be for that claim. If there is no claim, they just keep the premium and hopefully that the insurer will renew again for another year. In selling options world, is the terminology is called when the put option expires. So if the put option expires ITM, which means in the money, i.e., that the current price is below the strike price, so let's just say that the stock closed at $87, the seller is bound by contract to buy the shares at the $90 strike, so for $9,000. If the option is out of the money, i.e., the closing price at day of expiration is above $90, the option buyer gets back his $9,000 collateral and obviously keeps the premium. In either section, the option seller and the car insurance company always keep the premium. And the final part is all about reinsurance. So, from a car insurance perspective, this is where they would go and buy insurance from another company to protect themselves against a catastrophic event, e.g., like an earthquake or a tsunami or any type of natural disaster, which would wipe out pretty much all the cars that they're insuring. From selling a put option, this is known as a hedge. So, this is where you could buy a put option on ABC Limited, farther out the money to protect yourself against a massive market loss, e.g., like we had it back in March 2020, where stocks absolutely tanked 30-40% in a short space of time. So buying that put option gives you that protection if that was to happen. Where I believe that selling options has its advantage over insurance companies is when they have to pay out or being assigned an option. Unlike insurance companies, where you incur a loss for making a claim, when you are assigned a put option, you now own an asset which has value, which you can either go on to sell, hold, or start selling covered calls to generate additional cash flow.